Let's get right to it. We'll go through what happened with the markets, the economic data releases, a lot of bubble talk going on, particularly when it comes to the U.S. stock market. A lot of things in the press this week. People, as we're getting into the end of the year, the outlooks are coming out. You're starting to get more and more uh, people on Wall Street talking about the fact that things are extended and we're due for a correction. I'm going to go back and just as I go through the AI news for this week and some of the things that I wrote on my Substack, I'm going to take a look back at this concept of software eating the world and how it's very difficult to look at the global markets as the US versus the rest of the world. And then finally, I will go through what is becoming a debate on Twitter in terms of Bitcoin and MicroStrategy, and I think that is causing some of the bubble talk that you're starting to read more about. So, just in terms of the S&P, another another move to all-time highs. We are now. This is a chart I brought back up a while ago. We've never had a year where both the S&P and gold were up at least 25%, and currently year to date through Friday, both are up almost exactly the same at 27%, just highlighting the fact that liquidity is driving assets. Um, IWM has kind of stalled near the all-time highs. When you look at the chart, if you're looking for anything that says the U.S. stock market is a bubble, uh, this chart just I don't see how this doesn't work itself higher. It's also not going to explode, in my opinion, but the chart looks good and it continues to sit near the highs. The Mag 7, this is the Bloomberg Mag 7 index, is now starting to accelerate into the end of the year. You've had a big move higher after a period really from early July until early December. So, really, about 5 months where there was really not much gains, and that's because NVIDIA, as I've shown in prior ones, had been going sideways. This is not a Mag 7 story right now. We are definitely, as I've talked about, expanding the rally into the AI adopters. This is the Morgan Stanley AI adopter index relative to the S&P, and these are monthly performance. So the AI adopters, which are really, as I've talked about, going to be the ones that benefit the most from the move from the infrastructure stage, the building out for AI, to the adopter stage, which is going to include the AI agents. It'll include some of the storage side. It'll include some of the data analytics side. You've already had the data center group move, which was part of the infrastructure, and you had the chip side. So we're starting to get into something which should benefit more companies rather than just a concentrated few. And that's why you've seen this just really big movement in the growth software index. So this is the Morgan Stanley growth software. So software, or the application stage of AI, is starting to take over. You're seeing it a little bit in terms of the white line there, which is this is the pure factor growth, pure factor value ratio. So believe it or not, as the NDX over the S&P, which is the orange line there, was outperforming since ChatGPT. So this is when ChatGPT was released in November of 22. You had a rise which was dominated by the Mag 7, but all of these smaller innovation names and software names, a lot of them were on the other side of AI, meaning the disruption side on software. Well, now what you're starting to get into is the names that are actually going to benefit from it are starting to benefit, and you've had Trump take over, which has accelerated kind of this thought that small will do better in terms of places that had been regulated, open up the M&A side, and that's why you're getting this change, and it makes sense. So I think if you're looking for places to find things, I think the small and mid cap area, I think you have to find places that are going to benefit from AI. This is not a sector-based thing. This is not a all small caps and all mid caps are going to do well. And that's the thing that you're going to start hearing me talk more about is get your brain out of sectors and industries and cap weightings of things that are based on history. They're not relevant anymore as AI explodes and benefits certain companies, and then the ones that don't adapt to it are going to die. On the economic side, the aggregate payroll number Again, I'm just going to quickly go through these because the economy is completely fine. There's the 3-month average of the aggregate payrolls, again, in no different of where it's been for a long time. So growth in the U.S. is good. The PMI data, new orders, for the first time since 2020, we have had 3 months in a row of increases in the new orders. New orders got above 50 for the PMI, so we've had 3 months in a row. And again, I think part of this is front loading of orders before potential tariffs. Part of this is just people seeing deregulation coming and getting more optimistic and more certain about the future, which has been a big negative for businesses in the survey and also the consumer confidence survey. And it obviously happens at a time when inflation has been low. And after the panic move higher in rates because we were going to just see everything, our debt spiral, our spending spiral, everything. Well, 10-year rates are going down despite the fact that the economy's fine. You've had 10-year rates now go back down towards 4%. So there were calls to 4.75%, 5%, but what's happened is rates have just kind of moved their way lower at this point. You've seen rates vol come down as we're still sitting in this kind of the lows of the last 3 years for the MOVE index. The VIX has moved lower, also at the lows, and sitting below 13. So really, you've had nothing there. And then gas at the pump is getting close to breaking $3. So we continue to move lower there. I'll keep saying it. I don't think we can have a real panic on the inflation side, which I do think will be a story next year. I gotta believe, based on the power needs that I've seen, that we're eventually going to see some up move in the energy space. But right now, gas at the pump keeps coming down. So until we see a change there, you're just in this kind of quote unquote Goldilocks, which I thought this post handled well. Stocks are at all-time highs, home prices all-time highs, Bitcoin all-time highs, debt rising, core inflation staying above 3%, and all of that, and the Fed will be cutting rates again in the next 2 weeks. It's now closer to 80-90% of the Fed cutting. So we're still having, with all of this stuff going on, the Fed cutting, and again, I showed this back in September. I'm going to bring some of these back, but for the Fed to be cutting when we're going to have expectations of profit, year-over-year profits going up significantly, the only time we saw anything like this was in the coming out of the 98 into 99 period. And if you look, very similar thing. We had a small drop-off in terms of year-over-year EPS, and now all of a sudden we're getting the rise. Well, you had this in 98, 99, which led into the internet bubble. So just unusual times for the Fed to be doing this to be cutting rates with this going on. And I showed this. We're now updating this, meaning if the Fed cut rates and you don't go in a recession, this is what the market has done since we have no signs of a recession. We're still growing at 3%. You've seen stocks go higher. So people that want to fade the fact that they're fighting the Fed, don't fight the Fed is a usually pretty good thing. So if you're shorting stocks or playing for things to go down, you are betting on a recession, which again is just not showing up in the data. So I mentioned the bubble situation. Michael Hartnett has been around a long time. He specifically warned, and to have this, you're going to start seeing me talk about this thing of cryptos being mentioned again in here. And really, in this case, I think the only crypto thing that's there is Bitcoin. So it should say Bitcoin. I believe this is something, Wall Street, and as I wrote in a tweet, I just think people are taking Bitcoin and taking MicroStrategy and using it to be bearish on the overall market. But he warned about problems growing and an overshoot and everything going on. Just so you guys get a history of the market, we're talking about in the U.S. this is the S&P 500. 33 of 44 years were positive. When you go through this chart here, which was put together by J.P. Morgan, it just shows the annual drawdowns that occurred during these periods. So we did have an 8% drawdown with a 26% return. We did have a 10. We are getting a lot of drawdowns that are far bigger than the drawdowns that were happening here in the 80s. and even for most of the 90s outside of the years that were down. Even in up years, we're getting big move down. So there's going to be a correction next year, at least one. I think there'll be probably two or three. And the reason for that is I do think at some point next year, you're going to have a big fall, even if it's 8-9% on the back of fears over the tariff situation. December is just not the right time historically to be too negative. Maybe we'll make a peak in December for short term. I do think the first quarter next year will be a little bit more challenging because I think underestimating the uncertainty over the tariffs is probably a mistake. But as long as earnings come in, it's not going to matter. And I just think earnings are going to continue to come in because the economy's fine, the liquidity's good, and we're entering another phase of the AI movement, as I'll get into. I'm just bringing this up, and this is not to pick on Michael Hartnett, but it's to make sure when you read people writing about bubbles, you really should go back and look what they were saying before he wrote in March of 24, sees characteristics of a bubble in Mag 7 and crypto. So basically the same thing he just said 9 months later. If you followed his advice then, the mega cap, the Mag 7 is up 47% or 46% since he talked about it, and Bitcoin's up 36%. I don't want to stop there. He also said major collapse could follow AI-driven rally, and that was in June of 23. He also said the same thing, sell the rate high, turning bearish on sentiment in March of 23. Basically, if you followed his advice on March of 23, the Mag 7's up 177% since that time period. Again, not to pick on Michael, but just, again, these people just write this stuff, and you have to go back and look at if they've been perma-bearish or if they've been calling for this before. This is Ruchir Sharma, this was a title in a FT article, I believe, on Monday. The reason I'm bringing this up is because now people are, this seems to be a consensus trade, is to fade the U.S. and buy the rest of the world. There's a huge valuation gap between the rest of the world, and if there's a broadening out of AI, I guess you can make the argument, but as I go through this, I just don't think it's to sit there and talk about it because it's outperformed. This chart says it all. Yeah, you've been a massive outperformance in the U.S. since 2010 versus the rest of the world. I will highlight 2010 is an important period. Yes, we were coming out of the great financial crisis, but I just wrote a Substack which went through this. There were major things that happened in the United States of America, in particular with the rise of the smartphone, with fracking, with other things that went through that have led this. And so the earnings have justified it at this point. So you're going to have to bet that there's some change in the earnings. This is why people are so enamored with talking about it, is because you look over time, and this is MSCI World performance relative to the S&P. This is an extended period. Again, they say GFC here, I say iPhone, I say fracking. You know, we went from a large oil importer to the largest producer of oil and gas. These are all important changes, and it's not to say that there won't be something that disrupts the U.S. I actually do have something that I've talked about, but I think this perma consistency is why people want to fade it. I just don't think it is a good risk reward, and the reason is this. So Mark Andreessen wrote this in 2011, one of the most famous tech pieces that has ever gone out. I highlight going back to read it. Why software is eating the world. The key thing there is the world. And if you go through and read about what just take his points, and I highlighted important ones. My own theory is that we're in the middle of a dramatic and broad technological economic shift, and with software companies are poised to take over large swaths of the economy. Many of the winners are Silicon Valley-based entrepreneurial tech that are invading and overturning established industry structures. Think Amazon. Think whatever you want. Just go through it. Over the next 10 years, I expect many more industries to be disrupted by software with new world-beating Silicon Valley companies. All of the technology required to transform industries through software finally works and can now be widely discovered at global scale. The reason I highlighted these, software is eating the world. So when you look at this and you go back and say, well, the U.S. has dominated, the U.S. has dominated because it's dominated on the technology side. Our technology, in terms of the U.S., has dominated the world, and there just has not been any companies other than in China that have been able to be the size. So when you're looking at the earnings, again, and you say world technology, where you've now gotten rid of the U.S., it's the same chart. So this is really not about the U.S. This is about technology. So you have to bet that all of a sudden something's going to change. Here are the weightings in the MSCI U.S. index. 31% is information technology. Consumer discretionary, which is almost all Amazon, is 10%. Communication services, which is Google and Meta and I guess Netflix is in here too. So you're dealing with over 50% of the U.S. now is technology. If you go to Europe, financials, industrials, healthcare, are you really going to bet that these spaces are going to be able to grow earnings? Are we going to start lending lots of money? Are we going to have some kind of boom while China's decelerating? I just don't see how people want to sit there and just say countries. They need to pay attention to what makes up the indices. The indices are not there. Those companies in the US that make up the Mag 7 that have this, if you go through their earnings, about 50 to 60% of their earnings come from outside the US. So they're not US companies on their revenues. So again, you have a very unique situation. And then the other thing is the profit margin story for these companies is absolutely insane, and it just doesn't stop. So their profit margins in the Mag 7, which have dominated, have gone all the way up here. And this is what you have for the S&P, and then the S&P X these companies, there's been no profit margin expansion since 2018. And this is the problem. So if you look at the US and you say, well, if it was X those companies, then you're not dealing with the same situation. And even that, to me, is not a fair comparison to do that. So when you go through Europe and you just look at it on the name basis, and I just did this to show, these are names that you've heard before. The US names, a lot of them were new companies making up the Mag 7, or companies that you never would have thought would have been there. These are companies that you've known for a long time. So there's just nothing there. They've got two tech companies, and I didn't highlight it, but their tech weighting was only 5% in Europe. So trading the rest of the world versus the US, I think, is a very dangerous thing. Salesforce. This week they reported earnings. Agentforce, which is their AI agent side, contributed to having a large move higher. This is going to be a major theme, and I just want to highlight for thousands of years, and I do mean thousands of years, whatever the first business had started, if you want to expand your business, you needed to increase employees. We are starting to get to the point where that is changing, and this is when you read about robotics and you read about AI agents, this is where things change, and you need the money to be able to do this at this point. So here's Salesforce.com. Here on the yellow line is their revenue. Revenue grew again, new all-time high. Here is their employees. Their employees are unchanged since the end of 2021. Here's where the revenue is. The revenue is gone up by about 20. Yeah, so you're dealing with an increase right there of about 33%, while they haven't had any change right now in their employees during that time period. Same thing goes for Google. Google's peaked at the end of 21 into 22, and remember, ChatGPT gets launched right here. Meta, same thing. So I bring this up because you're at a point where when you're looking at the valuation gap between Europe and the US, embedded in this is the technological advantage that the US has had. It is in the fact that they have these technology companies that have billions and billions of cash sitting on their balance sheet. So how do you catch up fast enough when these companies are integrated around the world, and now they're integrating software into their business? They may not grow earnings anymore. They're spending a lot of money on the CapEx side. But the question is, on this, it doesn't look to me like this is a big problem for the S&P where you should expect a big fall in a PE unless we're going to have one of two things, a recession or a serious inflation where rates are going to move higher. I don't see either of those as a base case for next year, or even a reasonable probability. So you're betting that Europe is going to see their multiples come up and this is going to come down, which may happen. But when you're going through a risk reward and you're analyzing the risk of a situation, I think a better situation is to go to the US companies. You have very similar valuation gaps and again, I'm not going to show all the charts, but the mid cap and the small cap in the US, if you use the S&P small cap, the SML, the mid cap, and you go and look for companies there, here is MSCI Asia, here's MSCI Emerging Markets, here's the Euro stocks. These things, and this is price performance, they just have not moved, and the reason they have not moved is they haven't had the earnings growth. In this case here, you've had the earnings growth at all levels. So you can go find small cap and mid cap right now, which have a similar valuation gap. I would just pick companies that are going to benefit from the AI movement, because I don't think we're going to have an ism that's going to bounce back up to 60. And I think that's what you would need, is a very, very strong industrial move. I don't think we're going to see that. I think it's going to be a hanging around 50 ism, which means a lot of the small cap companies are going to suffer from having rates at high levels and having the AI competition. Here's Bloomberg put this out this week. If you want to bet on this, you can go through it, but they're talking about the fact that maybe the Mag 7 will finally see their earnings slow down. This was a Citi report that came out this week. Highly recommend everyone reading it. I highlighted this. I've talked about this repeatedly. How do you value stocks in the future when you have a rise in robots coming? In this new Citi report, our analysts suggest there will be 1.3 billion AI robots by 2035. 1.3 billion robots working. How do you value companies the way you had in the past? This is Star Trek stuff. This is not something where you can use the history of the 1970s or whatever you've learned in the past and use it as a valuation tool. And that's why I wrote this Substack on chasing abundance. We're entering a world of abundance. That's what robotics and AI is taking us into. Valuations change. With inside this paper that I released this week, I just want to read one clip here. Or why in the stock market would small caps emerging markets in Europe remain oversold versus the S&P since the GFC, other than discounting a future where the competition for these companies is actually happening through AI and crypto, represented by Bitcoin. And this is the thing that I write about. If you want to short the US and you believe the US stock market has gotten too concentrated and there's just no way that this can continue, I happen to agree with that in a world of abundance, but I think the winner of that is Bitcoin. And so from a macro perspective, whenever I hear people talk about Bitcoin, they have not gone through and done a study on what actually is the blockchain, what it actually means for things. And if you believe in a world of deflation, which I do, where everything is deflating every single year through innovation and through technology, that is how you eventually get to the point with AI that you will eventually have just competition, and you will have a situation where there's no more scarcity. And when that happens, the tech companies will be underperforming something. The only thing they've really been underperforming at any point is Bitcoin, and that's what I think Bitcoin represents. So just to finish up the news for Bitcoin for the week, I think it's great that David Sachs, listen to him on the All In podcast all the time, that we're going to have an AI and crypto czar. Again, the justification of why you should be focused on crypto and not believing it's a scam or a bubble. More and more stuff. The debunking thing, I'm just going to get through. Caitlin Long, who I mentioned last week on it, this continues to be a big story. You're going to see, we're going to need to have hearings in the banking committee. It's going to have to be a major topic of discussion with Treasury and people at the Fed, all on this concept of what was disrupting the acceleration of crypto. So again, use that as a choke point, as they talked about in here. Congress will be able to halt, reverse, and investigate choke point 2.0. This was meant to slow down crypto. So if you're going to have a government in that is going to be going through everything, this is, again, going through Operation Choke Point. This is going to be an opening of the doors and seeing what's been going on. At a minimum, the tailwinds are now with crypto. So if you think it's a bubble now, we haven't even started the new government yet. The president calls out Bitcoin. Again, he was someone who was negative on Bitcoin just 6 years ago. Putin, who can ban Bitcoin? Nobody. Jerome Powell, Bitcoin is a competitor to gold, not the US dollar. Only reason I'm bringing all this up is all of these people that are respected across Wall Street are now, they're talking about it. They have to talk about it. It's something that has become more than just, it's a scam, it's bad, it's this. It's just part of every discussion. This is Larry Summers talking about how it's a horrible idea for Bitcoin Reserve. You also had former president of New York Fed, Bill Dudley, also questioning the idea of a strategic reserve. Importantly, if you haven't read this, the Treasury Borrowing Advisory Committee, which meets regularly, this was a digital asset presentation that was done at the most recent meeting in October. If you go through it and you go read about it, you will see how, again, these presentations, these conversations are happening with people that are involved on Wall Street. So the more and more that I hear people continuing, and I would say 9 out of 10 people either don't own any crypto, they own a small amount, or they fade it every day. And this is Wall Street people that I speak with. They just have not figured a way to value it. They've not figured a way to embrace it. I'm trying to provide information on where you can go spend time reading about how it's becoming part of our world. It is part of Wall Street now, whether you believe it or not. I thought this was good in terms of every time we go into a bubble. This one, her definition, I agree with. Oh, it's a speculative bubble. Oh, they cut rates to 0. That's why it went higher. Now it's just the election and lobbying. I tweeted a thread just because on Friday it got to the point where every single thing I read in Twitter was one person saying it's a bubble and a scam, and then a zealot saying it's going up and it's never going to stop. So I put a thread out on why I don't think it's a bubble and what signs I'd be looking for that it was a bubble, since this is not followed by macro people. So the charts that I show, most people are just not following. MicroStrategy has been the best thing for Bitcoin, in my opinion, from keeping Wall Street people from being involved in it. They see it as a bubble. They can't possibly understand how someone could be doing something as simple as borrowing money for 0% interest rates and then turning it and buying into Bitcoin, and how this won't end badly. If Bitcoin falls to 10,000, it will end badly for them. But in the meantime, it's creating more of a fear that bubbles always burst, and I think that's going to keep people from being involved. So this thing is going higher with a lot of skeptics still. And yet the second biggest cryptocurrency, Ethereum, has not broken out yet. So how can it be a bubble if we don't have Ethereum going out? We had Ethereum at the prior bubble point in 2021 making new all-time highs. The small cap portion, the altcoins, have not gone up there yet. I referenced my son in the piece because during this period, people were printing money, and now you have gone up since the election, but it's still not there. So to finish off this week, this is the chart that I'd be following. I believe that, as I said, the correct trade to be short the U.S. is to be long Bitcoin versus the U.S. Well, this is that trade with the best of the U.S., meaning the Mag 7. So this is Bitcoin relative to the Mag 7. For a trade next year, this is what I think is a great long short trade until we can get up. These were the points where the prior two bubbles ended up. Bitcoin needs to outperform the AI Mag 7. And then once that happens, we can see. But for the time being, I just don't see any signs of a bubble here. I still believe Bitcoin will be the best performing asset next year. I thought it this year. I thought it last year. I'm still believing that this is a major, major transition, and AI is speeding things up. And now the government friction, which was preventing it from going higher, where it wasn't that long ago, we were talking about banning it. Now it's being mentioned at meetings. Now it's being mentioned by presidents. Now it's being part of everything that we do each day. So I think this is the beginning of something big. That's it for this week. I'll see you guys next week.